In 1982, a 32-year-old investor sat in front of a congressional committee and told America that a global economic depression was coming. He had studied the data. Mexico had just defaulted on its debt, and banks across the world were heavily exposed. Every signal he tracked pointed toward a collapse. He was so certain of his analysis that he went on national television to broadcast his warning to the public. While his raw data was accurate, his interpretation of it was deeply flawed. He had fallen into the trap of absolute certainty. The global economic depression he predicted never arrived. This graph shows the path of the market starting in late 1982. Instead of following the downward trajectory he projected, the market experienced a massive upward surge, entering one of the strongest bull runs in history. The man who had bet his firm's future on the opposite outcome watched his company collapse. He had to lay off every single employee.
With no money left to pay his own family's bills, the former financial prodigy was forced to borrow $4,000 from his father just to stay afloat. That man was Ray Dalio. And the question is, how someone who lost everything due to such a public miscalculation goes on to build the largest hedge fund on Earth? To understand Dalio's error, we must go back to 1971, when he was a 22-year-old clerk on the floor of the New York Stock Exchange. On August 15th, President Nixon went on television and shocked the financial world by severing the US dollar from the gold standard. Based on conventional logic, Dalio assumed this disruption would trigger panic, causing markets to crash the very next morning. Look at this diagram comparing his expected crash with the reality. Instead of plummeting, both the stock market and gold surged upward together in what became known as the Nixon rally. Dalio looked at the data and realized his own experience was a tiny, misleading sample size. To understand what markets would do next, he had to look past the few years he had personally lived through and study history on a much larger scale. Applying those observations, Dalio founded Bridgewater Associates in 1975 out of a spare room in his New York apartment. His initial business model was steady and straightforward. He advised corporate clients on how to manage currency and interest rate risks. The firm grew rapidly through the late 1970s. Dalio made a series of accurate bets on economic trends, which quickly attracted institutional money. But a steady string of correct predictions slowly mutated his analytical confidence into ego. He began to forget the humility he had learned back in 1971. That ego, built over years of being right, is exactly what blinded him to his own data and walked him into the catastrophe of 1982. After the devastating 1982 collapse, Dalio sat in an empty office and completely reevaluated his entire decision-making process. Analyzing current events wasn't enough. Truly understanding economic movements required studying centuries of historical cycles. This timeline charts his shift in methodology. Rather than relying on gut instinct, he zoomed out to a 500-year scale to identify repetitive patterns. By cataloging historical crises, he found specific crashes that mirrored the 1982 defaults, revealing the mechanics of market behavior. The goal of this new machine was no longer to predict the future perfectly. It was to mathematically protect the firm against human blind spots. The ruined 32-year-old eventually transformed Bridgewater into the largest hedge fund in the world. Bridgewater's massive scale didn't come from a streak of lucky guesses or perfect foresight. Instead, the firm's growth was rooted in the wreckage of 1982. Dalio used that intense public humiliation to systematically build a formidable engine that valued mathematical survival over flawed human opinion. True vision in business requires letting your most painful failures permanently expand your historical perspective. Ultimately, the destruction of his ego allowed him to build a firm that thrived because it stopped trusting any one person's certainty. Picture standing in the absolute wreckage of your career. For Ray Dalio, that moment arrived in 1982. He had just endured a public failure so complete that he later called it the undisputed lowest point of his professional life. The strange part about this collapse is that his underlying math was sound. His research on the mounting international debt crisis was actually incredibly precise. He correctly saw that Mexico had borrowed far more than it could ever repay. As the local economy stalled out, he knew a catastrophic default was mathematically inevitable. His error happened the moment he stopped analyzing data and started trying to read minds.
He bet the survival of his firm on a single, unwavering assumption about exactly how policymakers would respond to that default. The government intervened in a way he didn't expect. The market rallied instead of tanking, and because he had wagered everything on his one prediction, his firm was effectively wiped out. He didn't respond to this humiliation by trying to build better predictive models. He stopped trying to predict the future altogether, focusing instead on a much harder problem: engineering a system that would keep him solvent even when his guesses were entirely incorrect. Relying on a solitary genius to accurately forecast the global economy is a mathematical trap. Human arrogance guarantees that eventually you will develop a blind spot, and the market will find it. Dalio set out to rebuild his firm's investment strategy entirely around agnostic preparation. No more crystal balls, no more prophecies. A standard financial portfolio usually requires a specific environment to thrive. If those conditions change, the portfolio sinks. He mapped a grid of 4 environments any market faces: growth, recession, high inflation, and low inflation. Rather than spreading dollars evenly, he balanced the mathematical risk. If recession hits, assets positioned for bad times compensate in real time, holding the structure's shape. Bridgewater eventually called this the all-weather portfolio. Today, the broader financial industry knows this fault-tolerant framework simply as risk parity. It removed the investor's ego entirely. The math generates returns without anyone in the room ever needing to guess what tomorrow's headline will be. But a mathematically rigorous model is still dangerous if the humans operating it are overconfident. To solve the human element, Dalio mandated a cultural overhaul inside Bridgewater that was deeply uncomfortable and often brutal for the people working there. He introduced radical transparency. Every meeting was recorded. If you made a prediction, it was on tape, permanently removing plausible deniability. Junior analysts faced a strict mandate. They were required to directly challenge the assumptions of the senior executives in the room. That rule of mandated friction applied to the very top. You were expected to point out the flaws in Dalio's logic right to his face. The constant, raw debate systematically stripped hierarchy and personal pride out of the firm's daily operations. This cultural shift operated as a rigorous filtration system. It was engineered to catch the quiet overconfidence that triggered the 1982 crash, neutralizing the error before it could reach the trading floor. Through the 1990s and 2000s, Bridgewater scaled. It grew from a decimated advisory shop into a massive force in global finance. Foreign governments, global pension funds, and vast university endowments became their primary clients. These institutions weren't hiring Bridgewater because they thought Dalio could predict the next market top. They were buying a strategy explicitly designed to navigate the unknown. Dalio had secured his legacy. He is celebrated today as the architect of a highly resilient system, rather than a prophet with perfect foresight. Market mastery rarely comes from being the infallible genius in the room. It comes from having the humility to admit exactly where your judgment fails, and the discipline to build a machine that protects you from yourself. On September 15, 2008, Lehman Brothers filed for the largest bankruptcy in American history. This chart shows the devastation that followed. By the end of the year, the average hedge fund had lost 19% of its value, and several of the oldest institutions in finance were completely wiped out. The professionals who built their careers on understanding risk were caught completely off guard. The standard models that Wall Street relied on to navigate the market had failed. 2 hours away, at a hedge fund in rural Connecticut, the atmosphere was completely calm. This chart compares that negative Wall Street average to Bridgewater Associates, whose flagship Pure Alpha fund actually finished 2008 in positive territory. The firm's founder, Ray Dalio, survived because he had tracked the warning signs in the credit markets for over a year. On August 10, 2007, he wrote a private memo warning his clients that a financial hurricane was forming off the coast of the global economy. If a hedge fund manager knows a massive crash is imminent, the standard move is to bet every dollar on that single prediction. Dalio refused to do that. To understand why, you have to look at what happened to him 25 years earlier on a very different trading floor. In 1982, a young Dalio looked at the data and concluded that American banks had loaned too much money to emerging markets. He was absolutely certain the economy was heading for a depression. He was so confident that he went on national television to declare it, and he positioned his entire portfolio to profit from the collapse. He was completely wrong. The stock market triggered a massive rally instead, and those positions nearly bankrupted his firm. Losing his money forced him to realize that staking your survival on a single forecast is a guaranteed way to eventually destroy yourself. So, when those familiar cracks started appearing in the subprime mortgage data in the summer of 2007, he reacted differently. He still had the same strong conviction about a debt crisis, but he refused to go on television to brag about it and didn't bet the firm. This 3D schematic illustrates how he approached the problem. He treated his 2007 forecast as just one input, a single gear, within a much larger mechanical system. That prediction was plugged into the broader portfolio to capture the upside, but the rest of that system was mathematically balanced with assets that would perform well if the crash never happened. The structure itself absorbed the risk. By 2008, he hadn't become a flawless forecaster. He had built an architecture that didn't require him to be one. The institutions that vanished during the global financial crisis were the ones operating without those structural fail-safes. Meanwhile, Bridgewater survived the stress test and eventually grew into a firm managing over $150 billion. Dalio summarized the lesson from these two vastly different outcomes with a strict rule about trying to predict the market. He who lives by the crystal ball is destined to eat shattered glass. The young trader from 1982 assumed that absolute conviction was the only way to generate a massive return. The veteran who navigated 2008 understood that certainty is actually a trader's greatest vulnerability. If you're managing risk in a chaotic environment, your edge does not come from having perfect foresight. It comes from constructing a portfolio that holds up even when your strongest beliefs turn out to be completely backwards. Ray Dalio's most important trade was the choice to stop rolling the dice on being right and start building an engine that wins either way.